thanks for joining me on my market report. My name is Mike, and my market report is on mortgage rates. We discuss what's impacting mortgage rates on a daily basis, whether it might come from the economic calendar or a combination of that with headline news or geopolitical items out there. But sometimes it gets really confusing when the market sentiment changes and all of a sudden good news is now bad news and vice versa. So we try to give you the thoughts and what investors are thinking and what's driving the markets on a daily basis, so that way you can better prepare yourself. So if you're just in the industry, you just kind of at least get some idea of what's going on with the market. But also if you're following along because maybe you're looking to refinance or purchase and are just checking out where rates are at and want to see if it's a good time to lock in or kind of do what you're going to do. Hopefully this will give the information that you're seeking and make an educated decision for yourself. So a little bit about myself is I am a loan officer. I do work with a national lender. We lend in all 50 states. If we can help you with any of our purchase or refinance needs, please reach out. We'd love to be able to show you what we can do for you. But more than that, we like to be a resource. So if you guys got any questions about anything, again, please feel free to reach out. We'd love to be able to help you guys out. Without further ado, we'll just jump right into it today. We'll start off today with the economic calendar. Today we do got a few more items today. It's been a pretty light week in terms of what's on the calendar, but today we got the weekly jobless claims that we get. So last week it was revised slightly higher from 229,000 people applying for unemployment to 231,000, and forecasts were supposed to be a slight dip up to 227. Well, after the revision, we got the slight dip, but if we kept the same number, it would have been unchanged to 229,000. But more importantly, we saw an uptick in the continued claims. So now we saw more people applying, and so this is something we'll want to monitor to see if right now we're at peak capacity in terms of jobs out there, but now we're starting to see some weakening in there. So we'll have to kind of wait and see if we are going to see more people applying for unemployment or if and more job losses, because the big thing is right now on the minds of investors is that we're looking at a possible with the rate hikes and the aggressiveness of the Fed's path that they're trying to fight inflation, that we could force ourselves into a recession, and at that point, people are looking to layoffs. We'll have more layoffs. Things change then. But to continue on with the economic calendar, we do got the market services and we got the manufacturing. So we'll look at the services for the month of June. Anything above 50 is considered expansion on these two indexes. The first one was back in May at 53.4. Forecast was supposed to be a slight uptick to 53.5. Unfortunately, it went downwards to 51.6. And manufacturing had similar sentiments. Went from 57 in May. Forecast supposed to be a slight downturn to 56, and it dropped much more to 52.4. So obviously not great, great overall data right there. We have seen that with the manufacturing, with the New York region. We also saw that the Philly Fed, and both of those show contraction. So this is something we'll definitely want to monitor as well, as we kind of see the economy is showing some signs of possibly slowing down, even though we're in the second day of the Fed Chairman Powell speaking before Congress, and today he's speaking before the committee from the House of Representatives, and basically, again, reiterating everything, feeling that he didn't really talk about recession. He says that there's a possibility of it, but obviously the first and foremost, they're trying to fight inflation. That is the biggest thing. He doesn't want to be compared to Paul Volcker, who was the last time back in the 70s, 80s, when he raised rates so high we were in double digits and basically forced ourselves into a recession. So he's trying to stay away from that, but in the meantime, he feels that the economy is strong enough to go ahead and withstand the higher interest rates. Markets are kind of hesitant or really maybe not necessarily agreeing with all that. So stocks were down earlier on. They're starting to open up a little bit, and we're starting to have a little mixed results right now. This is a little bit at the result of bonds. Bonds got some early movement early on. It helped us out as it kind of went all the way up to like plus 72, 77. Has subsided some since earlier this morning, and this has been going on the last hour or so that the mortgage-backed securities were down. We got our good news basically from Europe, where they had the poor news with their PMIs that came out. So those poor PMIs kind of sparked a rally in their bond market in Europe, which kind of trickled over to the U.S. here, and we started getting more bond here. Now we're starting to create a little bit more liquidity in the markets, and we're starting to see some more fluctuation. So we were up about 77 basis points, and then we, as you saw, we're down down 30. We're only up by 33, but now we're back up to 48. So we're starting to see some volatility here early on today with the movement. But what does this really mean? Well, we're up a bit, and that is granting better pricing for us in our rate sheets. So our rate sheets should look a little bit better today than where we left off yesterday. And we did close up 45 basis points. So we are getting closer to the 25-day moving average, which is good news. Something we haven't seen since earlier this month when we had that big free-for-all after the CPI report kind of tanked the markets and hurt us. And now we're kind of gradually working our way back upwards on that. So to take a look at the treasuries also dropped dramatically. We're also getting pretty close to the 25-day moving average here. We're down to just under a 3.05 right now. And lastly, let's take a look at the average rate for conforming limit. And again, they do have points built in, and they're based off of yesterday's rate because it's what after the rates, after they're delayed by a day. So the 15 years at 5.34, and the 30-year is at 5.88 now. So we dipped back under 6%, which is obviously good news. And also, if you guys got any. So that's pretty much the wrap for the day. If you guys got any questions about anything, or we could be of any assistance, please reach out. We're here to help you guys out. In the meantime, if you could please help us out and smash that like button and share, we greatly appreciate that. Thank you so much for watching. We'll look forward to see you guys in tomorrow's video. Have a great rest of your day. Bye-bye.